Welcome back for another deep dive. Today, we're jumping into, well, a really hot topic, inflation versus deflation.
That's right, and we're doing it through the lens of Kartik's analysis. He often takes a pretty contrarian view on this.
He really does. So our mission here is to explore why Kartik argues that all this fear about inflation might be a bit overblown, and why he thinks deflation is actually a much bigger threat.
Yeah, and we're drawing this directly from his audio analysis. What's striking is how consistent he's been.
Consistent how?
Well, even when everyone was screaming about runaway inflation, Kartik was pointing elsewhere, looking at the underlying mechanics, the cause and effect. He wasn't buying into the panic.
Okay, so let's start with that common fear of inflation. Kartik mentions it himself, right? Like those YouTube searches, inflation will kill you, that kind of thing.
He does. And he specifically calls out figures like Robert Kiyosaki and Peter Schiff. He suggests their economic thinking is maybe a bit dated, like 1950s era, not quite fitting today's world.
And he's apparently debunked them elsewhere, though we won't get into all that detail here.
Right. But his core point is interesting. He thinks inflation sells in the media. It makes for good headlines.
So the fear gets amplified.
That seems to be his take. And that this might lead the public to, maybe unknowingly, favor deflation, which he sees as much worse.
Which brings us right to his main argument. Deflation is way worse than moderate inflation. Maybe even slightly high inflation.
Unless it's hyperinflation, he clarifies. But he's very clear. We are nowhere near that.
Okay, so how does he illustrate this? He uses a comparison, right?
Yeah, a direct one. So picture an inflationary economy. Let's use his example. Maybe your income goes up 4%, but inflation is running at 6%.
Okay, so you're losing a bit of ground. It's not great.
Exactly. It's an inconvenience, definitely hits lower income folks the hardest. But Kartik frames it more as a nuisance, not the end of the world.
Right. Not catastrophic. Now, contrast that with deflation.
Okay, so deflation, prices drop maybe 2%. Sounds pretty good initially.
Sure, cheaper stuff.
But Kartik asks, what if that comes with widespread job losses? What if your income gets cut by 50%, or you lose your job entirely, a 100% cut?
Oof. Yeah, that's a different story.
His argument is that almost everyone would choose the inflation scenario, that 4% income gain versus 6% inflation over facing significant unemployment or income cuts.
That makes intuitive sense. And he links deflation directly to a poor job market.
He does. Because our economy is so heavily based on debt, deflation makes it really tough for capital to get returns, especially using leverage. Less return means less investment.
Which means fewer jobs. A downward spiral.
Pretty much. He traces that cause and effect quite clearly.
He also uses a housing market analogy, which I thought was quite effective.
Oh yeah, the mortgage example. It really clarifies the debt aspect.
So walk us through it. Inflationary scenario first.
Okay, so you have a fixed rate mortgage. In an inflationary environment, your income tends to rise over time, even just modestly.
Right.
So that fixed mortgage payment becomes a smaller and smaller slice of your monthly income. It gets easier to pay.
He mentioned people who bought houses in the 70s really benefited from this.
Exactly. He basically says a mortgage is like a leveraged bet that local inflation will happen. Wages and home values will likely rise while your payment stays the same.
Okay, now the flip side. Deflation.
Same fixed mortgage payment. But now, imagine your income is stagnant, or worse, decreasing because of deflationary pressures on the economy. That fixed payment suddenly becomes a much heavier burden. It's a larger percentage of your shrinking income. It creates a lot of financial stress.
And that's why he calls deflation catastrophic for people with debt, which in the U.S. is a lot of people.
A huge number. It underlines his point that focusing only on the price of milk going up misses this massive benefit of moderate inflation for homeowners with mortgages.
It's a perspective shift. We focus on the small daily costs, not the big long-term debt dynamics.
Right. Kartik thinks our fear should be geared more towards deflation's potential to destroy jobs and make debts unbearable.
He then connects this to broader economic growth and asset prices, especially with technology advancing so fast. He calls it exponential technological deflation.
Yeah, this is interesting. He suggests that rising net worth as a percentage of GDP isn't necessarily a bad sign. It could actually mean growing prosperity overall.
Even with wealth concentration.
He acknowledges that concentration is a separate issue that needs addressing. But the overall pie getting bigger, fueled partly by tech that lowers costs, he sees as potentially positive.
And he ties the recent spike in net worth, post-COVID, to QE quantitative easing.
Right. He thinks the temporary inflation bump we saw was largely a consequence of that massive QE response.
Yeah.
And his expectation was that it should settle down as things normalize.
It always comes back to cause and effect for him, trying to trace the real drivers.
Absolutely. Like looking back at the 2008 housing crisis, he emphasizes it wasn't just rising prices, but mortgage debt rising much faster than prices. That leverage was key.
And he argues QE actually prevented a total collapse, like a deflationary spiral similar to the Great Depression.
That's his view. He credits QE with stopping that catastrophic outcome, even though he has mixed feelings about how it was done, like the Fed buying mortgage-backed securities.
Why mixed feelings?
Because it helped homeowners who already had assets but didn't do much for renters, for example.
Ah, okay. It wasn't evenly distributed help.
Precisely. But he also notes this funny thing where people see their home equity go up.
I think, wow, I'm a genius investor.
Exactly. They don't connect it to the same QE forces that might also be pushing up, say, the price of gas. Though he also points out gas prices are often driven by other things, like global supply and domestic production, not just QE.
So his overall take on QE is complex.
Yeah. Flawed, perhaps, but ultimately, he argues it did substantially increase the net worth of most U.S. citizens, except, crucially, the very bottom tier.
And for them, he suggests,
Direct cash assistance, not trickle-down effects. Again, focusing on direct cause and effect for helping those most in need.
to kind of prove his point about inflation fears being overhyped back then, he shared some data, right? An inflation scorecard from late 2022.
He did, yeah. October 12th, 2022. He looked at a few things. One was the 10-year average growth rate of the U.S. Consumer Price Index, the CPI.
And that was showing
About 2.5% annual growth over the previous decade. So moderate inflation by that measure.
okay. But he focused more on something else.
Yes, the Goldman Sachs Commodity Index. Its 10-year compounded annual growth rate at that same moment was actually negative 0.39%.
So deflation in commodities over a decade.
According to that index, yes. And Kardec argued this index is broader, globally priced, harder to manipulate, He saw it as strong evidence against the claims of runaway inflation that were everywhere at the time.
That really highlights his contrarian approach and, well, his track record of sometimes seeing things differently and being proven right later.
It does. He felt that index debunked the idea that CPI was being rigged to hide massive inflation. The raw commodities weren't showing it.
So his big warning is really about listening to the wrong narrative.
Essentially, yes. He warns against those constantly fear-mongering about inflation, saying they ignore or downplay the much more severe risks of deflation. He worries this creates a sort of miseducated population.
Which could have real consequences, maybe even for policy decisions.
Potentially, yeah. And just as a side note, he's also pretty skeptical about gold being this great inflation hedge people claim it is.
Why is that?
Well, he points out that despite all the QE, all the money printing people worried about, the price of gold hadn't really gone anywhere spectacular for years.
More evidence, in his view, that the standard inflation narrative might be missing something.
Exactly. It doesn't always fit the data when you look closely, according to Kartik.
So wrapping this up, the core takeaway from Kartik's analysis seems clear.
Yeah, I mean, inflation isn't fun, especially for those on fixed incomes or the working poor. But deflation.
Deflation poses a much deeper systemic risk, particularly with all the debt we have in the economy. Job losses, bankruptcies.
That's the danger he consistently highlights. His whole analysis, that contrarian viewpoint, it stems from looking really hard at those underlying causes and effects, not just the surface noise.
It definitely encourages you to think differently, to look past the easy headlines. So here's something to ponder, based on Kartik's view. Are we as a society maybe too focused on the annoyances of moderate inflation?
And in doing so, are we underestimating the potential devastation of deflation, especially its impact on jobs, on debt, on overall economic stability?
How does looking through this lens, Kartik's lens, maybe shift how you interpret the economic news you hear every day? Something to think about. Thanks for joining us on this deep dive.